Let's quickly revise accounting standard 22, which talks about taxes on income. Though the standard talks about taxes on income, we are not going to discuss about indirect taxes in this standard. All we're going to discuss is only and only about direct taxes. The way we compute tax amount that should be paid as per Income Tax Act 1961 is also told under Income Tax 1961. So the income as per books of accounts, which is prepared as per Accounting Standards and Companies Act, is not the taxable income. How to determine taxable profit on which tax has to be paid is given by Income Tax Act 1961. So the taxable profit which is computed as per Income Tax Act 1961 multiplied by tax percentage will give us current tax. Current tax is the amount that should be paid. On the other hand, amount that is determined as profit as per P&L account, that is based on accounting standards, is the amount on which we apply tax percentage to determine tax expense. In short, tax expense is net profit as per P&L account multiplied by tax percentage. Taxable profit multiplied by tax percentage is current tax. Tax expense which is computed on accounting profit is the amount of expense. Current tax which is computed as taxable income multiplied by tax percentage is the amount to be paid. These won't be same, they will be different. The reason for the difference between taxable income and accounting income, which will lead to difference between tax expense and current tax, can be categorized into two. One, permanent difference. Second one, temporary difference. Permanent difference is the difference which will arise in one period which will not get reversed in the subsequent year. On the other hand, temporary difference is a difference which will arise in one accounting period and it will get reversed in another accounting period. To give an example, depreciation. Depreciation under accounting can be done under WDV, SLM or production units method. On the other hand, under tax system, unless it is an electricity distribution or manufacturing entity, we have to follow WDV. Because the method can be different, the amount of depreciation will be different between taxation and accounting. Because the expenses by way of depreciation is different, profits as per tax records, profits as per accounting records will be different. When these profits are different, on this the tax amount what we compute will also be different. So the tax paid and tax expense will be different. This is only short term difference. This will get reversed in the subsequent years because over the entire useful life of the asset, we are going to charge a finite amount of depreciation. Depreciation will be same throughout the life. It might be charged little less in 1 year, little more in 1 year, but it cannot exceed the cost, it cannot be less than the cost. So that's the reason we call depreciation as timing difference. Or another expenditure which is temporary difference is preliminary expenses, which is regulated by section 35D of Income Tax Act 1961. As per accounts, if I incur any preliminary expenditure, I will charge it to my P&L account in very first year. Entire 50,000 what I have incurred as preliminary expense is expense in year 1. However, as per tax, only 10,000, that is 1/5 of that 50,000 is allowed as expense every year. So in accounts, I charge 50,000 to my P&L account in 1 year. In tax, I write 10, 10, 10 as expense over 5 years. Because of which profits under each of the years will be different. This is temporary difference. Now what is permanent difference? Example can be something like 40A2 or 40A3 or 35 scientific research. 40A2, if you make excessive payments, like you have appointed a clerk who happens to be your relative, he is a person with skill set which deserves salary of 15,000. Let's say you give him salary of 20,000. You made excessive payment of 5,000. As per accounts, we don't care about excessive expense or excessive payment. 20,000 per month salary will be our expense. However, as per tax, only 15,000 per month is allowed as an expenditure. 5,000 rupees, which is an expense paid to the employee in excess of his skill and caliber, is disallowed as an expenditure, and this is permanent disallowance. Similarly, similar to this is 40A3, wherein the cash is paid for an amount exceeding 10,000. Under tax, it is not an expense because it is cash payment. Under account, it's still an expense because we don't care about tax provisions when we start booking our expense in accounts. Because of these differences, profits will be different as per accounts and tax. On that, the tax that we compute also will be different. Between these tax differences, current tax and then tax expense as per accounts and current tax payment as per tax, whatever difference arises, we can create deferred tax asset or we can create deferred tax liability only if the difference arising is temporary difference. If the difference arising is permanent difference, there is no possibility of creating deferred tax asset or liability. whatever is our current tax as per income tax will be accepted to be tax expense and it will be charged to P&L account. However, if the difference is because of temporary difference, we arise the difference arising between our current tax to be paid and tax expense will be booked as deferred tax. Tax expense, what we charge on accounting profit, is what is paid this year, current tax, plus what is deferred and to be paid in later years. So by this we can conclude that there is a formula for determining deferred tax which goes like tax expense is equal to current tax plus deferred tax. Tax expense, what will be charged to P&L account, can be paid this year by way of current tax or can be deferred to be paid in the later years, that is deferred tax. If in case in this formula we substitute our current tax and tax expense, we can find deferred tax liability or deferred tax asset. After substituting tax expense and current tax, if deferred tax happens to become positive, that means there is further expense to be booked beyond our current tax payment, there is further expense to be booked. Such an expenditure, it is not current tax because we are not paying it now, we have to end up paying it later, meaning our tax expense is much more than current tax and that would lead to our deferred tax liability. Tax on accounting profits is more than tax on taxable profits. Tax expense is more than current tax and we create provision for this amount, we pay this amount. To the extent we don't pay now, we would have to pay later. It is some money that we are saving now, but we would have to pay later. So right now it is an expense which is not paid, which will lead to deferred tax liability. On the other hand, if our tax expense is less and we end up actually paying more, that excess amount paid will become our deferred tax asset. If in case in this tax expense is equal to current tax plus deferred tax formula, when we find deferred tax by substituting tax expense and current tax, if we get deferred taxes deduction, that means out of the amount that we have paid as current tax, expense is much lesser. Such a decrease in the amount is the money that we have paid now, which we will save later years, in the later years. So that would lead rise to deferred tax asset. In short, the formula is tax expense is equal to current tax plus deferred tax. In this, if the deferred tax resulting is positive, it is deferred tax liability. If the deferred tax resulting is minus, then it is deferred tax asset. The next thing that I would want you to note is there is another way of remembering this entire logic. It is if the tax expense is the expense that is computed based on accounting profit, tax payment is the payment that is determined based on the taxable profit. If in case our expense is more than payment, I mean to say tax expense is greater than current tax, what is happening? Expense is more, payment is less, we have to further pay, that is deferred tax liability. If in case our expense is less, that is tax expense is less, whereas current tax that we have paid as per tax provisions is more, that will become deferred tax asset. Obvious, isn't it? When the expense is more than payment, outstanding expense is liability. When the expense is less but the payment is more, it becomes prepaid expense, that is our asset. A beautiful shortcut to remember the entire thing that we've learned so far is yay, tell. Yay is A-E-A, tell is T-E-L, A-E-A. If accounting expense is more, it is asset. If tax expense is more, it is liability. A-E-A, accounts expense, if it is more, it is asset. If tax expense is more, it is liability, and this will solve a lot of your problems. Then deferred tax asset recognition should be done little wisely. You would have to be prudent, you would have to make a prudent understanding of the business scenario and then record it, because assets cannot be overstated. You would have read this in accounting standard 1, which talks about prudence when you're picking your accounting policy. Prudence says that we cannot overstate our profits and assets. And whenever you record deferred tax asset, it is an asset, it is a resource which is going to give you future economic benefit for the amount that you paid over and above your current tax, over and above your tax expense in the current year. You will create deferred tax asset only when there is a reasonable certainty that in the later year, the situation will reverse and we can adjust this deferred tax and only pay the lesser amount. Are you guys getting this? Right now our accounting expense is more, so we are creating deferred tax asset. In the later year, accounting expense should be less, that is tax expense should be more, for the reason of creating deferred tax liability. If you have created deferred tax asset in year 1, in year 2 we don't create deferred tax liability, we will reverse the deferred tax asset previously created. If there is a possibility in the future that accounting expense which was more in year 1 will become less in year 2, only then we would have to create deferred tax asset. If not, you should not create deferred tax asset. We call this reasonable certainty. However, if in an organization there is huge unabsorbed depreciation or huge accumulated losses which can be carried forward, what happens in this case is, in the future years, even if you make profits, that profits will be adjusted against unabsorbed depreciation. That profits will be adjusted against the carry forwarded losses, because of which the taxable profit becomes less and the payment becomes less, which will never give rise to scenario of utilizing deferred tax asset. So if an organization has huge accumulated losses or huge unabsorbed depreciation, then before creation of deferred tax asset, don't just check for reasonable certainty, check for virtual certainty, meaning there should be proof and concrete evidence that the deferred tax asset what you are creating in the current year will get reversed. I repeat, deferred tax asset creation is subject to prudence. It can be created only if you expect reversal of deferred tax asset in the later year. When you are creating deferred tax asset, please check for reasonable certainty that there is a possibility of reversal. However, if there is huge accumulated losses or unabsorbed depreciation, reasonable certainty is not sufficient. You have to check virtual certainty, that is proof with evidence. That's with regard to deferred tax asset recognition. So what would be the accounting entry whenever we're trying to account for deferred tax? Initially, whenever we take that expert's tax computation, to that extent we'll write tax expense account debit to provision for tax. When we write tax expense account debit to provision for tax, we're only going to debit the current tax amount. Current tax amount is the amount that should be paid to income tax department, and I'm crediting the same with my provision. After I make this provision only to the extent of current tax, that is taxable income multiplied by tax percentage, I will compare this taxable income with my accounting income. Accounting income into tax percentage, when I do, what I arrive at is the tax expense that I should be debited to P&L. If the tax expense what I compute as per accounting profit is more than the current tax, then I would have to create further expense. So I debit my tax expense account and credit deferred tax liability. But though I increase my expense by debiting tax expense, payment will be only to the extent of current tax. So to the extent I won't pay, it will become deferred tax liability. On the other hand, if my tax expense, that is on accounting profit, happens to be lesser than current tax, then what should I be doing? I should decrease my tax expense. Current tax what is debited is the tax that I pay, but my accounting expense is less. I should decrease this expense. In order to decrease this expense, I will credit my tax expense and debit deferred tax. So my payment is more than the expense as per P&L. Over here, what is happening? The expense is more than the payment, so it is deferred tax liability. And next, we need to set off our current tax and deferred tax. If it is legally enforceable that we can set off, it is arising because of the same purpose, then I will do set off. If not, if legally enforceable right to set off exists, then I will do set off. If not, I won't be doing any set off. Deferred tax asset and deferred tax liability, if it is computed under the same law for the same item, we can do setting off. If not, we cannot be doing the set off provision. Then let's talk about the minimum alternate tax and normal tax. Minimum alternate tax. See, with regard to deferred tax computation, don't ever worry about minimum alternate tax. First, finish off your entire deferred tax asset, deferred tax liability computations. Only when you're done with your deferred tax asset, deferred tax liability computation, then start with MAT. Because the standard 22 says that don't apply MAT in computation of deferred tax. So finish off your deferred tax, then start with MAT. MAT is regulated by section 115 JB of Income Tax Act 1961. As per the provisions of section 115 JB, we compute book profit for the purpose of MAT. On this book profit for the purpose of MAT, which you actually don't have to compute, will be given to us in the question. We'll apply MAT rate. MAT rate will be lesser than the normal tax rate because MAT profit will be more than the normal taxable income. So MAT rate will be around 10%. Book profit will be almost equal to accounting profit. So let's get back minimum alternate tax. So we'll apply the MAT rate on the book profit as given under section 115 JB. On that book profit, when we apply MAT rate, we will arrive at minimum alternate tax. As the name says, it is the minimum money that should be paid in alternate way other than the taxable income. Meaning what? If the taxable income multiplied by tax rate, whatever we find as per normal income tax rates, if it is less than the MAT, then we should pay MAT. If the taxable income multiplied by tax rate, what we determine as per normal tax provisions, is greater than the MAT amount, then we pay normal tax. The problem doesn't exist when we pay taxable income multiplied by tax rate, that is tax as per normal rates, is greater than MAT, then there is no problem. If the taxable income multiplied by tax rate is lesser than MAT, then this amount what you are paying in excess of the normal taxable income into tax rate, that amount is allowed to us as MAT credit, minimum alternate tax credit. And in the later year, when the taxable income multiplied by tax rate as per normal tax rate exceeds MAT, then minimum payment will be this much. To this extent, difference between these two, whatever MAT credit you have availed previously can be utilized and you can pay only MAT. Let us say MAT is 100, normal tax is 90. We have to pay 90 normally, but we paid MAT of 100. So 10 rupees what we paid in excess of tax, normal tax, will be MAT credit. In the later year, if normal tax becomes 15, normal tax becomes 15 and our MAT is 10, that 5 what we are paying in excess of minimum money, that can be utilized from the MAT that we have already paid. So though normal tax is 15 and MAT is 10, I won't pay 15, I'll pay 10. 5 of MAT whatever is available will be, whatever was credited previously will be utilized. If MAT is over, then we would have to end up paying the normal taxable income. And this is with regard to our minimum alternate tax in comparison with normal tax. The journal entry will be provision for tax will be debited, MAT credit when you are creating it, you are debiting it, and then you credit bank. MAT credit is like asset. Later when you utilize MAT credit, you will be crediting the MAT credit amount. Got that? Then if MAT credit is greater than normal MAT, this is what I was just trying to tell you people. And MAT has to be created only when there is a MAT credit can be availed, only when there is a reasonable certainty that it will reverse in the future year. If you think, see, this is your tax, normal tax, this is MAT. Right now, what your normal tax is less and MAT is more. You end up paying MAT. This MAT will become your expense unless until there is this scenario, whereas your taxable income will exceed MAT in the later years. If you expect taxable income and normal tax to exceed MAT, where you can avail your MAT credit, if that scenario is possible, you will avail MAT credit. If the possible scenario is this and you never expect the situation to go this way, then don't create MAT credit. Book the entire amount of tax that you pay as your expense. So don't book any MAT credit. Again, prudent estimate is what we are trying to do. And the last point is with regard to tax holiday. In the case of startups, a special feature is allowed by the Income Tax Act of 1961, which says that a startup need not pay tax for 5 years in the first 10 years. So when tax holiday period is allowed to any of a startup or any entity, then they need to recognize their deferred tax liability only and only if it will get reversed beyond that tax holiday period. If that deferred tax liability is getting created during tax holiday and it is getting reversed during tax holiday, then there is no point in creating. No, tax holiday period you don't pay any tax. If deferred tax liability is getting created during tax holiday period and it gets reversed beyond tax holiday period, only then you need to create deferred tax liability. So this is the point that I want you to note with regard to deferred tax liability along with tax holiday. I hope you understood this quick revision of Accounting Standard 22 Taxes on Income.